Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you're doing well today. We are back talking about some earnings. Last week, one of my holding, Waste Connection, ticker WCN, reported their earnings, and I got a few questions from readers, from members, from listeners about Waste Connection because it's not going anywhere this year. Actually, it is slightly up right now. The Canadian ticker is up like about 2% year-to-date return. You could argue you're not losing money on it. And you could also argue the fact that the entire market is up like 20% or something like that. So definitely not a good year for Waste Connections when you compare to the TSX. So before we get to the results, that is one really important point, because at first I was like, what's going on with the TSX? And then I realized, well, there is a huge gold rush. And as people are buying more gold, well, you guessed it, all gold related companies, the gold miners and so on, they are skyrocketing. And this is a big part of the TSX that's pushing the index higher. Big comeback this year from some Canadian banks such as Scotiabank and CIBC, and all the other banks are doing well as at the same time. So another push over there. So that explained a big part of why the market is going up. While Waste Connections has nothing to do with the hype around AI, nothing to do with the hype around gold, unless we start putting gold in our trash, right? So that also explains the fact that the company is not performing that well. And we're gonna get there at the end of this show today. We're gonna talk a little bit more about why the stock is not performing, but just wanted to highlight, be careful when you compare to the market for a very short period of time. I know people love doing this, but if you do that for like 3 months, 6 months, a year, and you compare with the market, I mean, you're either going to be lucky or unlucky, but that's about it. That's the only thing that you can get out of like short-term comparison. So please stop doing that. You're just creating more noise in your portfolio. Anyways, back to the results. Actually, at first, when you look at them, you're just like, yeah, those are kind of mixed results. You have revenue up 5%, but earnings per share down 7%. So already when you see this, you have to think, okay, so how is it possible that you're making more sales? Or in this case, they're charging for collection, of course. So you sell more of your service, but earnings are down. So earnings are down either because you spent more, because there are some accounting stuff that is going on, such as impairment or amortization, or there must be an explanation. Because in an ideal world, when you grow your revenue, you want to have your earnings going up about the same pace. That would be the perfect scenario. So for Waste Connection, well, the major growth vector for the revenue was actually core price. So the price was up by 6.3% on their service. It was offset by weaker volume, though, and also weaker performance from the recycling segment. So volume declined by almost 3%. Recycling segment was down 1% in revenue, so that partially offset the growth from core pricing. But overall, I mean, mid-single digit growth for the revenue, definitely a good quarter. Now, for the earnings per share, this is where it gets interesting. So this is where you have to go into the press release and dig a little bit further, or you just open your DSR Pro report and then you see it right away, because we do that job for you guys, for all the DSR Pro members. So what happens with the earnings per share is because they have impairments on it. So it's affecting the earnings, but not the cash flow and the ability to generate cash flow. So on that side was good news. And the adjusted earnings per share was actually up by 6.7%. So almost 7% for the quarter. So now you have a business growing mid-single digit. The earnings were actually up 7%, which means that they have better margin. They focus a lot on efficiency this year. And on top of that, some other good news, Waste Connection over the quarter completed repurchasing shares program of 1% of outstanding shares. So grabbing some stocks at a weaker price because this year, as I just said, was not performing that well. And on top of that, you got a juicy dividend increase of 11%. So the more cynical investors will tell me, but Mike, you're talking about a company that offers a yield of like 0.80%. So what's the point? I mean, if your dividend increased double digit, it's not just about the yield, it's about the health of the company and how the business will likely continue to thrive. And this is the important part. When management increase their dividend double digit, they tell you we have a bright future going forward. And this is what I want as an investor. This is what I want to see. And this is what makes me happy, thinking that the management team is telling me, yes, we're going to continue to go up and grow the business so you can be a happy shareholder. So now, back to the problems that we have right now. Waste Connection is not performing on the market, and it's supposed to be a defensive stock. So what's going on? Well, here's the thing. First, for defensive stock, they prove their value when the market goes down or when there's a lot of uncertainties. Right now, there's a lot more hype than anything else. Everybody's happy. Everybody's a genius. They're making a ton of money. A lot of stocks are skyrocketing. So a boring company taking care of trash and recycling, not going to get much love from the market. So that's first. So that's why the stock is barely making profit this year and trailing the S&P 500, the TSX 60 for the past 3 and 5 years. Now, the second thing to consider, which is probably the most important reason why WCN is not performing right now, is they have been reporting good but not great results this year. So we expect high single-digit growth for revenue, for earnings. It's not a surprise that they came up with an 11% dividend increase. Last year was like 10.5. The year before was also double-digit. So the market is kind of used for that. The stock is also priced for that. The forward P ratio is around like 34, I think. So again, if the company is at a very high P ratio and a forward P ratio as well, the guidance were reaffirmed, which is great, but then there's no new information to drive the stock price. Results are in line, the guidance is in line, and then the company's just doing what is expected. Well, there's no reason to get some hype, right? So that, unfortunately, because there is a very high P ratio, so you're already paying a premium for this kind of company, the market is not willing to pay even bigger premium. So that's pretty much what's happening here. Of course, we do have some uncertainty about the headwinds in terms of like the volume decreasing a bit, the recycling segment not doing that great either. So those are like small hurdles, but if you combine the fact that the company does not generate better returns than expected, which usually will push the price higher up, and on top of that, it's a boring stock, and we are in a super hyped market about AI and about gold and about everything that is exciting, well, then you get a lot of the lineups, and that's just only the reason why the company is not doing that great on the market. But personally, I don't care. I don't care because when I added Waste Connection, first, it was for a defensive play when the market's going to go down. Right now, it's not happening, so that's a good reason why WCN is not performing. And the second thing is, I don't judge a stock value or a performance based on like short-term results. I added WCN this year, so of course I'm not making money on this one, or barely making a few dollars, but I don't care because I intend to hold Waste Connections for the next 10 years and more. So what's the relevance of looking of over the past 6, 7, 10 months, right? Nothing. And it doesn't give you the value of a stock. Next week, we're going to have like a full week about Brookfield, actually. So it's going to be a very interesting one. You want to subscribe to the podcast or on the YouTube channel to not miss those episodes. But if you look at Brookfield Renewable, it has been dead money for a long while. And this year it's like up like 40% with the dividend included. So the key point was I kept those shares all that time, even though I was not making money because the metrics were great. Waste Connections is growing its revenue. it's growing its earnings, and it's growing its dividend. It has a strong dividend triangle. And for that reason, I'm going to keep on holding those shares, and I won't mind short-term stock performance. So, all right, Moose, just to end, next month in November, we're going to hold a free webinar about retirement. So Retirement Loop is reopening their doors, starting with a webinar on November 13th. So you can register for the 6th retirement upgrade webinar at retirementloop.ca/webinar. So it's retirementloop.ca/webinar. Do not miss the webinar if you're Canadians and if you are Canadian and about to retire, or if you just retired a few years ago. So it's really for those who are like 5 years before retirement up to 5 years into retirement. This is the moment where you have the most important decisions to make about your retirement plan, and some of them are going to be hard to reverse, so you want to make sure that you get them right first. So anyways, retirementloop.ca/webinar. I'm going to see you there, and tomorrow we're going to keep on talking about the stock market. Until then, don't forget to stay invested.